ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
What does a board-certified ophthalmologist, a surgeon who spent decades performing precision eye surgery, have in common with the world's most elite chart readers? The answer, my friend, is an expert understanding of patterns, immense discipline, and an almost microscopic attention to detail. Hello, everyone, and welcome back to Traders of the World, the podcast where we dissect the minds of the market's greatest masters. I'm your host, Flávio Lemos, and with me today, I have a special co-host, Mr. Felippe Aranha, a great price action professional trader. Felippe Aranha is one of Brazil's most respected price action traders, renowned for being the primary authority and popularizer of all Brooks methodology in the country. He started his career in the early 20s. He built his reputation on a pure indicator-free approach to reading the markets through his influential book, Price Action Avançado, né? In extensive education work, Aranha has mentored a generation of Brazilian traders to focus on disciplined, context-based analysis of candlestick patterns and market structure. Hello, how are you doing, Felipe, today?
I'm very good, thank you very much. Above all of these things, I'm a student of my master, L. Brooks. So everything I know, I learned from him. I got to know L. Brooks in 2009. I'm one of the oldest students in the world. I found one that is older than me, that is Robert. I met him last year in the seminary. By the way, L. Brooks is attending another seminary in Orlando this year. I'm going to be there too. And last year, I got to know that I'm the second, at least that I know in the world. So I'm very honored to have L. Brooks here and to be here with Flávio Lemos too, which we feel is a big authority of charts in Brazil, maybe the most authority in charts in Brazil. So thank you very much for the invitation.
Thank you.
Flávio, and thank you very much, El, for attending this interview.
Okay, today we are truly honored to have a living legend with us. He's a man who transitioned from the operation room to the trading floor, and in the process became one of the most respected voices on pure price action trading. He's the author of definitive, almost encyclopedic books like Trading Price Action Series, the Bible for many traders, covering trends, trading ranges, and reversals. He's a former physician, a futures trader, a technical analyst for Futures Magazine, and the mentor behind thousands of traders at brookspriceaction.com. A fascinating story I came across is that Al didn't just stumble into trading. While still practicing medicine, he spent years, almost a decade, relentlessly studying charts, trying to find an edge that indicators and news couldn't provide. He approached the market with the same diagnostic precision as a surgeon, looking at each bar as a piece of evidence and a clue in the market's history. That relentless pursuit led him to become the master of price action he is today. So let's count some candles. Get your charts ready because class is in session. It's my absolute pleasure to welcome the master of price action himself, the legendary Dr. Al Brooks. Hello, Al.
Hi, Flávio. It's very kind of you to have me. Felipe, it's always good to see you. Thank you very much for being here. I hope your audience can find something useful from what I'll be saying today.
Okay. I'll just share a bit about our incredible journey from medicine to the market. For many, that seems like a leap between two different universes. So let's start here. How did the mindset of a surgeon, the discipline, the risk management, the high-stakes decision-making prepare you for the psychological battlefield of training?
Well, it's interesting. At least to me, it's interesting. I became an ophthalmologist, an eye surgeon, simply because my mother told me to become an eye surgeon. I grew up poor, and in our community, you do what your parents expect you to do. So early on, my mother told me, Al, I want you to become an eye surgeon. And I didn't even consider what I might want to do with my life. I just decided that, that you got to do what your parents said. So I became an eye surgeon. And then somewhere along the line, I decided, wait a minute, this is not really what I want to do. I want to be in business. I want to be in finance. I want to be a trader. So I started looking at charts, and I found them fascinating. And then when I compared to what I was doing as a doctor, it's not like the television shows that you see and you see doctors solving these great mysteries, and it requires a lot of brain work, and you come to a conclusion. That's not the way medicine is. The way it is when a patient walks in, within 5 seconds, you know everything about that patient. And if you're doing an operation and you get 20 of the same operations today, there's nothing challenging. So there was no intellectual challenge to being a doctor. Once you have your degree and you've practiced for a number of years, everything is just very routine. Yes, it's nice to be helping people, but I'm pretty reclusive and pretty shy. When I do come out of my shell once or twice a year to go to meetings or workshops, but fundamentally I'm a shy person, and I really like to think. My greatest happiness in life is thinking, and I like looking at every bar during the day. I trade 5-minute charts, and I see something to trade on every bar of every chart all day long. And I probably have looked at more 5-minute charts than anybody on the planet. I probably have thought more about charts than just about anybody on the planet. And I'm very, very comfortable doing it. And it's doing it all these years now. It's been 40 years now. It's still fascinating. Every day, I just love watching it unfold. And one of the fun things for me is I see something happening in the market, and I have a good sense of what the possibilities are that will follow. And I'm never surprised by anything. I'm very comfortable with everything. And I feel like as things are unfolding, I know what's going on. I know what the buyers are thinking. I know what the sellers are thinking. I know where the forces are. I know where the magnets above and below are. And it's very peaceful. When I started out, I used to just tear myself up inside because I couldn't understand why the market was doing something. If it looks like it's going up and then it starts going down and it goes down relentlessly, it would be really, really upsetting. I remember having those feelings, but I don't have those feelings anymore. I just know that it was very, very difficult. But then somewhere along the line, I started to get a very good understanding. And I'm at the point now that I'm just totally at peace all day long. Even if the market is doing something crazy, making extreme moves.
It does all the time.
I just, I said, oh, look at that, it's doing that, and I save charts. Every day I create maybe 5 or 10 charts of different things that happen during the day, and I file them away. And I have, I don't know, probably 10 or 20,000 charts stored up. So if I see something happening today, like a gap up, a bull breakout, and then a trading range, I can go look at my file of gap up, bull breakout, and trading range charts, and I can refresh my memory of what is likely to happen later in the day. So it's a really fun game, and I just don't get bored with it.
Yeah, market always surprises us every day. It's why I love it too. I'm an engineer. In engineer, I have to work around workers, buildings, bridges. So a lot of routine. I think the same. So fantastic. Let's dive right into some questions. Which where you live? Here are the questions our audience is dying to hear your answer. You are the synonymous with the term price action. Many new traders think it's just trading without indicators. How do you define price action? And what was the aha moment that made you abandon everything else and focus solely on bar by bar narrative of the chart?
Price action simply means how the market is moving. And you can use that to get an idea of what will likely follow. So you just study, is the market going sideways? Is it going up? Is it going down? Is it about to reverse? Is it going to break out? You look for behavior in what's in front of you to get an indication of what is likely to follow. And indicators are all based upon charts. So, I've written countless indicators, and I've done all kinds of testing, long ago, and they're just all based on charts. And what happens with a lot of, especially people starting out, when they use indicators, they don't look at the charts, they look at the indicators. The chart is there, but they're not looking at the bottom at the indicators. And, to me, that they're afraid to look at the charts. They don't trust their own ability to understand, and they're looking for a God to protect them, a savior. And that little indicator down there is going to be their path to making money. They're going to follow that indicator into great wealth. And it's nonsense. Those indicators are based on the charts. And if you create indicators, you come up with a concept based upon behavior. You're simply programming your observations. And also indicators, a lot of them are oscillators, and that's a real problem if the market's in a trend, because let's say the market is going up and you're looking at some kind of an oscillator like RSI or stochastics. It's always forming divergences and tops. So if you're looking at an indicator, you're always looking to sell, when in fact you look at the chart and it's clear you should only be buying. There are many more important things to look at that you can see on a chart that indicates whether it's going to continue up or whether it's going to pause or whether it's going to reverse. And most of those things are not, you can't see them in indicators. Theoretically, you could program a dozen different indicators and have a dozen different indicators on your chart looking at different aspects of price action. But for me, it's simply easier just to look at the chart. I want to see what the pullbacks look like. I want to see what the breakouts look like. I want to see what the breakout points look like. I want to see how close the pullback comes to the breakout point. I want to see if it dips below it. I want to see how many consecutive bear bars there are in the pullback. I want to see if the bear bars are big and closing on their lows. I want to see if they're consecutive big bear bars closing near their lows. I want to see if there's a big bear bar closing near its low, and when the next bar opens, are the next few ticks up or down? Are traders looking at that bear bar as the start of a continuation down, or are they looking at that bear bar as a great opportunity, a brief opportunity to buy at a great price? So those are all things that you cannot see with indicators, but you can see by looking at the charts.
John Bolliger always told me that some guys tell, oh, look at my indicator. He has like 9 indicators, all of them deriving from some price or some closing or high and low. And if you got like moving averages, they are mostly all the same. Okay, exponential moving average, it responds closer to the price, but they all have the price as the meaning source of the information. So Felippe, I'm sure you want to make the question about the always in mindset. So,
yes. The always in mindset, it's very revolutionary concept that you brought to traders. And for traders who usually wait for the perfect setup, it helps them at least to decide one piece of the puzzle, which is the direction they are going to trade. So for these trades, for these traders who usually wait forever for the perfect setup. What do you think the always-in approach, how do you think the always-in approach can help these traders to wait less and act more in the markets?
Well, you know, if you look at websites, you see perfect setups, perfect wedge tops with perfect sell signal bars, or perfect wedge bottoms, or perfect double bottoms with great looking buy signal bars. And that's not the real world. You know, if you look at the past week of charts and find how many perfect signals you'll see. You might see one or two. I see something to do on every bar during the day. So I think, you know, a person is wasting their time looking at looking for perfection. A lot of the best trends begin with something that looks good, but not perfect. And if it looks good and the context is good, the bars to the left, you know, is it at a support level? You got to take the trade. And, you know, a simple way to think about it is if you figure out how much money you have to risk and you go for a reward that is at least twice your risk, mathematically, you're going to make money. And that's because for 95% of the bars on the chart, you cannot be more than 60% certain of what the next 10 ticks will be, up or down. And you can't be less than 40% uncertain. So you live in a probability of between 40 and 60%, you know, for 95% of the bars on the chart. 5% of the bars on the chart, the trend is so strong, a series of big bull bars or a series of big bear bars, the probability of the market falling 10, 20, 30 ticks before it goes up 10, 20, or 30 ticks is 70%, right? But for most of the bars, there's a lot of uncertainty. And, you know, you just accept that you're going to be wrong. You know, assuming you're an average person, you're going to be wrong at least 40% of the time, and you're not going to be right more than 60% of the time. And, you know, you just look for setups that are good enough, and if you go for a reward that is at least twice your risk, you know, you're going to make money. Now, for always in, on the 5-minute chart, an average trend typically lasts at least a couple hours, and it'll usually go 3 or 4 times the size of your risk. So if you're in an average trend and you hold, you know, if there's no reason to exit, you're going to make 3 or 4 times your risk. And, you know, given that you had a 40% probability of the trend working, you know, you can end up making pretty good money. As far as always end goes, you look at a chart and you ask yourself at any moment, is it better to be long or short or flat? Okay. For most traders, they'll choose flat, but for a lot of times, you know, I'd say most of the day, it's fairly clear whether it makes more sense to be long or short. And so if a person is trying to stay in the market always, or most of the bars of the day, at any moment, he decides, is it better to be long or short? And he takes that position. And then if it's better to be short than long, he'll exit as long and get short. And, you know, if you do that, and you look at your chart all day long, you know, let's say you get the start of a bull trend, always in long, and then it keeps going up, 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 and then there's some kind of a topping pattern that is good enough to go short. You know, you get out of longs, and now the market's always in short. So one good part of that is it forces you to trade. And let's say the market is breaking out strongly to the upside, and you say, oh my gosh, I didn't take the original signal, and now it's 4 bars later. Okay, well, think about it this way. If you did take the signal, you're currently long, you may have taken some profits, whatever size position you would still have right now, you could put that position on now. So if you missed the original trade, you should put that position on right now. It doesn't matter when you take a trade, you know, on any given bar, you just ask yourself, where was the original signal? What would be my position size right now? If I'm flat, I take that position size right now. Where would my stop be? Well, I use that stop. So, and if you're entering very late, you know, I usually tell traders, if the risk is big or if the probability is low, trade a small position size. And by small, I recommend trading about 20% your normal size. So if you normally trade 5 contracts, you know, trade 1 contract. And then if the market goes up the size of a scalp, and then there's another signal, put a second contract on.
Yeah.
If it goes up the
What the position? Okay.
to scale into a winning trade. And you're not going to make as much money as the person who bought the original signal, but you're still going to make pretty good money instead of watching all day hoping for a pullback. You know, put something on, even if it's very small. Look where your stop has to be. If your stop gets hit, how much are you going to risk? And that determines your position size. And if you don't want to spend a lot of time being precise, just put on a 20% size position, and then manage it the way you would manage it had you bought the original signal.
Okay. So let's talk about the periods of the first test. You often advise traders to be extremely cautious and perhaps not even trade the very first test of a major support or resistance. So this is contrary to what many classic textbooks teach. Why is the second or third attempt of often the higher probability trade, and what are you looking to see in the price action between the first and the second test of a support and the resistance level?
Okay. All right. So you're referring to a strong trend and then a reversal. And if the market is, let's say, we'll talk about bulls. If the market's going up very strongly and you get a reversal and it lasts 4 or 5 bars, 70% chance there's going to be a second leg sideways to up. So do you want to be shorting when you know there's a 70% chance it's going to go back to the high or higher? No. But if it goes back to the high or high, back to the old high, and the traders who bought at the top decide that the sell-off was so big, it's better now not to be holding long at the top. So they bought at the top, it goes down, and up here they say, I don't like the size of that sell-off, I'm going to exit. If a lot of traders do that, and if a lot of bears bet that the market has either converted into a trading range or is reversing into a bear trend, they'll sell. So the market likes tests. So anytime it does something, especially if you're looking for a reversal of a trend, the market wants to be certain that that the trend is actually reversed. So they want to see a test. So if you're looking for a bottom and you get a very strong bear trend, sometimes you'll get a reversal that goes up and turn into a bull trend. But most of the time, the market has to stop going down, enter a trading range, and then the probability of a rally, a bull trend, becomes higher. You know, if you have a strong bear trend in a trading range and you get a buy signal, 40% chance that buy signal will lead to a bull trend. 60% chance it'll either lead to more trading range or a resumption of the bear trend. You know, the way I look at it with the tests is if the market's going down strongly and goes up, okay, there was a lot of buying. Most of that initial buying is going to be bears buying back shorts. And if the rally is strong enough and then the market resumes down, a lot of bulls will wonder if the market is reversing into a bull trend or converting into a trading range. In either case, they're going to look to buy around the first low, betting that there'll be a rally that will be big enough for them to buy. So also, if you're a bear and there's a big bear trend and the market goes up and you took profits, okay, are you going to sell again or right away? Probably not, right? If the reversal is fairly big, you're going to wonder if the market has converted into a trading range or reversed into a bull trend. So you want to see if the bulls will buy again at that price at the bottom. So you give the bulls a second chance. Will they buy again? And if they buy again, you know, a lot more traders will say, yeah, the bears tried twice to get a price lower than the first low, significantly lower than the first low. They failed twice, and the bulls succeeded twice. So anytime you're looking for a reversal, you'll get a much higher chance of actually having a reversal if there's a test. And the test could be a double bottom, or it could be a wedge bottom. If you think of a wedge bottom, all it is 3 reversals instead of 2. And instead of them being around the same level, they're slightly different. So the bears failed, we got a rally. The bears failed the second time, we got a rally. The bears fail a third time. If you're a bear, are you going to be eager to sell again? Probably not. If you're a bull and you see 2 prior reversals and now it's reversing a third time, you're going to be much more willing to buy.
Let's get the bears on the feet, by the feet.
I want to say something about this. This dynamic that you are describing, you also describe in your books that can happen in small amounts of times, like a micro double bottom, micro top as well. It's not only for big double tops. There's also micro double tops, or also low twos and low threes, right? Of time too.
Okay, let's talk about one of the wonderful things that I heard about you and in your books, and I now watched several speeches of you. The virtue of patience, waiting for bar 18. So let's talk about the market open. It's chaotic, filled with motion and false signals. You have a famous guideline about staying patient for the first hour, or specifically waiting until after bar 18 on a 5-minute chart. Can you walk us through the logic of this rule and explain what kind of a clarity a trader gains by letting the initial dust settle?
Well, you can trade. Let me give you some examples. Let's say there's a big gap down on the open, and the first bar is a very big bull bar closing near its high. There's a 30% chance that will be the low of the day, and that is a reasonable buy. Okay, you should buy above that first bar. On the other hand, let's say the first bar is a small bull bar closing around the open of that bar, and the next bar is a big bull bar closing near its high. You should buy above that bar. All right, but let's say neither bar is big and neither bar closes near its high. Then you should wait. All right, and a lot of times you'll get some kind of a small rally and then a test down and then a double bottom. Right, 80% of the time, if you have a big gap on the open, up or down, the market is going to be sideways, or pretty much sideways, for 18 bars, 24 bars, a couple hours or so. And let's talk about an example of a gap down. The bears will look for a rally up to around a 20-bar exponential moving average. And that rally, they'll expect it either to be a wedge rally, and they'll look for a sell-off, a reversal down from around the moving average, or they'll look for some kind of a double top around the moving average. If they get either of those and they get a bear bar closing near its low, they're going to short, betting on a swing down. The bulls, on the other hand, will look for, like I said, strong buying on the first bar, or a wedge bottom. So it goes up a little bit, down more. They'll look for a wedge bottom or a double bottom, and then they'll buy. But they're going to look for a strong buy signal bar. If you're a bull buying in a bear trend, a strong bear trend, a big gap down, you want as many bullish things as you can get, and you definitely want a bull bar closing near its high. It could be the first bar, it could be the second bar, it could be 20 bars later after the market forms a double bottom. And if you're a bear, let's say the first couple of bars have bull bodies, even if they close near the middle. Let's say you got the first 5 bars. Let's say 3 are bear bars, but none of them is big and none closes near its low. Are you going to sell? And the answer is no, because if you're getting average looking bars, look at the average price. The moving average is one measure of the average price. If the moving average is up here and your average bar is down here, you're not going to want to sell far below average. So you're going to wait until the market goes sideways to up until it's closer to the average price. And then you will be willing to sell bars that look average because it's now at the average price. So these are the kinds of things that I look at all day long. If the market is sideways, let's say yesterday ended with a trading range, and then today the first several bars have prominent tails up or down, and you get a bull bar, bear bar, bull bar, alternating every 1, 2, or 3 bars. I don't want to be doing anything other than waiting. I want to wait for a good looking bull bar closing near its high at the bottom of the trading range, and I'll buy that. Or I'll look for a good looking bear bar closing near its low at the top of the opening range, and then I'll sell that. It's better to wait. If you're a really experienced scalper, you can make a lot of money with limit orders. Anything bullish, you sell. Anything bearish, you buy. So if you see a big bear bar closing near its low and you have a trading range, you buy it. You use a wide stop, scale in lower. And at the top, if you see something bullish, like a breakout above a prior high, and the bull bar closes near its high, you sell it. You know, you don't buy it, you sell it, because the market is probably going to continue to do what it's been doing. And if it has been going sideways and having a lot of reversals, it makes more sense to bet on a reversal than to bet on a successful breakout. And if you get consecutive big bull bars closing near their highs, and both of them close above all the prior highs, and the body of the second bar is completely above the trading range, that's a strong breakout and a 70% chance the market's going to go up for a measured move. So that's an example of a trading range converting into a confirmed bull trend.
Okay. You place a huge emphasis on identifying two-legged pullbacks, often calling them one of the most reliable setups in any market. For the viewers, could you describe what a leg one is equal to leg two, measured move looks like, and why this simple pattern is so powerful and recurs constantly?
Well, most of the trading is done by computers. Computers use math, and you have to have some rationale for doing things. And the computers are always looking for measured moves. If the market breaks out of a trading range, breaks above a trading range, the computers are going to take profits at a measured move up based on the height of the range, right? They bought at the top of the range, their stop is at the bottom of the range, and the probability was high if they had a strong breakout that the market's going higher. So they're happy to take a profit that's equal to their risk. So they'll take profits at a measured move up, right? And leg one, leg two, that's another example of computer math. You know, let's say you have a two-legged pullback in a bull trend, that second leg down, if it falls below the first, the bears are hoping that it's a lower low after a lower high, and the market has become a bear trend, right? So that break below the first low, the bears are hoping will convert the market into a bear trend. The bulls are betting that no, it's you know, it's a bear trap, trapping bears into a bad short, and they're going to look to buy. Some will buy as the market falls below that first low, and others will buy at some kind of mathematical move. And one common thing is a second leg down that is the same size as the first. So a leg one, leg two measured move. 50% pullback is another common one. Another one is a pullback to test the breakout point, the top of the trading range. Very often you'll have several things at the same time. You'll have a leg one, leg two measured move that retraces 50% and tests the top of the trading range. And if you get a really good buy signal bar, you've had several good reasons to buy. The probability is going to be 60 or 70% that the market is going to go back up to the high.
Many traders struggle with trade management more than entries. You are a proponent of scaling into positions. Can you explain the strategic advantage of scaling into a trade versus using a single entry with a fixed stop, especially in strong trends or complex trading range?
Let's talk about strong trends. If the market has a bull bar closing near its high, and then another one, another one, another one, the first bear bar, there's going to be a 70% chance there'll be more buyers on the close of that bar and below that bar. So I would not exit below the first bear bar. But if there's a second bear bar, second consecutive bear bar closing near its low with a reasonably big body, typically I will get out. I wouldn't short, but I would get out. And because sometimes you'll get a buy climax, especially on the open, and it just immediately reverses down in a series of bear bars. So if I see two bear bars after a strong bull breakout, I'll exit. And if the next bar is a bull bar closing near its high, I can always buy again. So I will not be missing much of the trade. If the market's more two-sided, deeper pullbacks, complex pullbacks, multiple legs, I'm more inclined to use wider stops, but I'm also more inclined to scalp more. So if if I think the market's converting into a trading range, I'm going to be looking to sell out of longs on strong legs up near the top. So as far as the patience go, the patience, whenever a person uses the term patience, I always think of trading range. And so let's say the market is selling off very strongly, and it has a pullback, and then another low, and then another pullback, and it's stair-stepping down. But if you notice that the market pulls back, goes up, and the bounce goes above that prior low, okay, think about that, all right? So if the pullback goes above the breakout point, a trader who bought that low and bought more lower, and then the market goes back here, he can get off break even on his first buy with a profit on his lower buy. And, you know, so I look for that kind of behavior. And if I can see the bears making money with limit orders, if I can see the bulls making money with limit orders in a bear trend, that's what I'll start to do. You know, I'll start to buy at prior lows and add on the size of a scalp lower. Or if the trend is fairly strong, I'll start buying at the size of a scalp below the prior low and add on lower.
Well, it's important to say that in his books, in his course, he's always says you never should risk more in the position when you are scaling in, right? So you should enter you should enter lower, smaller. So if you're going to trade, let's say 10 contracts, well, you can go on.
Let me answer that. Felipe, you bring up a really good point, and it's probably the most difficult thing for traders starting out, okay? They'll see somebody on television, a trading expert, say, oh, I bought NVIDIA today, and if it goes lower, I'll buy more tomorrow, right? That is an experienced trader, right? He's comfortable doing that. And what happens with the beginner is, it's high probability to do that, by the way, right? But this is what happens invariably with the beginner. A beginner uses limit orders, and he scales in, and he does really well. You know, he scales in once, scales in twice, and he finds that he's making pretty good money for 2 or 3 weeks. And then one day he scales in once, he scales in twice, and it goes down a little bit further. He scales in a third time, then he scales in a fourth time, and then the market never goes back up, and he ends up losing more on that one trade than he made in the prior couple of weeks. And that's one of the biggest reasons why beginners lose money. You know, they do enough things well to make money, but they do one bad thing that's terribly bad, and it erases all of their winnings. So the point is, the best way to make money is stop doing dumb things, right? If you can get rid of the bad things, you know, the odds of you making money are really good. Now, limit orders, scaling in, okay, that is not for an average trader, okay? An average day trader should not be scaling in, because he'll get scared and he'll manage it badly. An experienced trader, I talked about trading a 20% position size. An experienced trader in a bear trend, if he sees the pullbacks going above the breakout points, he'll buy maybe a 20% size position. And then if it goes down the size of the scalp more, 20% more, 20% more, okay? So he's trading really, really small. So whatever a beginner thinks is a small position, it's probably twice as big as what small really is. So a beginner thinks, I'll trade a half-size position, and that's small. No, that's not small. You know, if you add on once, you're up to a full position, and you know that's not small. So beginners should not be entering with limit orders. They should not be scaling in to a losing trade, and they should not be using wide stops. If a beginner wants to scale in, the best way to scale in is in the direction of the trade. So if a beginner buys and the market keeps going up, and it goes up the size of a scalp, and then has another reason to buy, a bull bar closing near his high, he can add to his position. And one thing he can do is exit if the market falls the size of a scalp below the prior bar. So, because if it falls the size of a scalp below a bar, then a bear selling with a stop below that bar had the ability to make a scalp. And in a strong bull trend, the bear should not be able to make money. If the bears are making money, it's not a strong bull trend. So stop trading it like a strong bull trend. So that's what I do.
Your books are incredible, detailed, and analytical. But how much of trading success in your opinion, is this logical analysis versus pure emotional and psychological management? And how does a trader know if they are making a logical mistake versus a psychological one?
Yeah, that's a very difficult question to answer in a way that's
That's
going to
why
be
I
helpful.
asked you.
Yeah. Okay. The simplest way is look at your account. Okay. If your account is smaller today than it was when you started, don't assume it's psychology. Assume it's your trading. And I spent a lot. I hired psychologists. I took psychology courses, and this is like 30, 40 years ago, thinking it was really important, and it was really not important. The single most important thing is learning market behavior, understanding price action. The better you understand it, you don't even think about psychology yet. I'm at peace all day long. I'm happy all day long. And it has nothing to do with psychology. It has entirely to do with learning how to read charts. So I would not, I think spending a lot of time on psychology is really not going to be helpful. What you have to do is, get good at reading charts, understanding what markets are doing, and focus on that, and the psychology will take care of itself.
Stupid mistakes, stupid behavior, and avoid doing stupid things that can hurt yourself, right? Like trading too big for for the size of your account, things like that. These things are technical, right?
Traders should trade the smallest possible size until they're consistently profitable. Everyone who starts trading has dreams of becoming rich. Okay, I'm going to become rich. I'm going to become super rich, and that's wrong. I mean, it's a nice dream, but there are many steps to get there. And the first one is starting to place trades. And then the longest stretch in the process is learning how to stop losing money. So you're going to lose money, and it could be losing. I lost money for like a decade back in the 80s. But once you get past that, then life becomes a lot easier. Also, I make more money than I can possibly spend, right? And my goal now is not to make money. My goal now is to be happy. And, I want to have fun. I want to enjoy my life. And I don't, back then, my goal was, I want to become a billionaire. And, it's really wrong to focus on that. What you need to focus on is stop losing money and then start to make a little bit of money, and then slowly increase your position size. And you don't have to increase your position size very much to make a decent living. The difference between making nothing and making what a lawyer or a doctor earns, being a lawyer or a doctor, it really doesn't take a very big position size to make a pretty good living doing this. Focus on not losing money, starting to make money consistently, and then slowly increase your position. And invariably, once you increase your position, you're going to make mistakes and you'll lose money again. Well, then go back to your previous position size. And that whole process, it's not something that takes a few months. It'll take at least a couple of years to work through all of that.
You have been studying charts for decades. How has your own personal trading evolved? Do you trade differently now than you did 10 or 20 years ago? Are there setups you use to take that you now avoid, or vice versa? And I have one more question with this. With the rise of the high-frequency trading, the AI, and the algorithmic systems, some argue that classic chart reading is becoming less effective. Do you believe in pure price action we will always have an edge with the computers?
Yeah, let me answer that in two parts. Long ago, I used to be really smart. Okay, I used to be super, super smart, but I was losing money as a trader. And now I'm an old guy, and before I could just look at a strip of numbers, 2-digit numbers, and I could add them up in my head as fast as I could type them into a calculator. Now, if you give me two-digit numbers to add, it would take me a minute to add them up. So my IQ is substantially less than what it was long ago, but I'm substantially a much better trader. Okay, so everybody has more than enough IQ power to become a trader. What you have to work on is the ability to understand what the market is telling you, and then structuring trades and managing trades correctly. And that does not take, you don't have to be a genius to do that. I think most people have the ability to do that. High frequency trading, okay? You have computers that, or firms, there's a node where the internet comes up in Manhattan. And the rent and those in the buildings right there and next door is super high, because there are hedge funds, high frequency trading firms, that want to be as close to that internet as they can to gain some nanoseconds faster prices. So let me get a drink of water, excuse me. So when a trade actually takes place and you see your chart move, it might take, half a second, a quarter of a second, sometimes it might take 2 or 3 seconds. So your real-time chart is not real time. It's delayed. And by the time that trade takes place and you see the movement, high frequency trading firms have already placed 10 trades, all right? So before you even see anything on your screen, they've already placed a bunch of trades. So you at home, do you want to compete against a high frequency trading firm? No, they have a tremendous advantage over you. Their advantage is speed. They get that data before you get data. They can analyze it faster than you can analyze it. They don't have to push buttons to place trades. They don't have to make decisions to exit. They're trying to make 1 tick, 2 ticks, 3 ticks profit. They're scaling in constantly. They're doing all kinds of things that you cannot do. If you try to get good at that, 100% certain you're going to lose, because they can do it consistently 24 hours a day forever. Even at your best, you're not going to be as fast as them. You're not going to analyze as well as them. So that's trying to compete against the high frequency trading firms is meaningless. As far as them altering the markets, they're high frequency trading firms. They're holding positions for a millisecond, 5 nanoseconds. They're in and out. I don't see them as competition at all. There are much bigger factors that influence the market. Oracle having surprisingly big profit projections. That kind of stuff is much more important. Every company has many facts coming out every day. Every government has many facts coming out every day. Then there are technical things every day. So I don't worry about competing against computers. The market ultimately is going to be controlled by forces that that unfold in our time frame. As I said, I can see trades. I can see trades on every bar. I can see something to do on every bar during the day. And the high frequency trading firms may have taken 1,000 trades during that 5 minutes. It doesn't matter. I can look at the bar and I can see trades that I can take on my time frame, that I can structure, and I can make money. And I don't feel threatened by the high frequency trading firms at all. Are the buy and sell signal bars less reliable, or are the good ones less frequent than they were 30, 40 years ago? I would say yes, but that still doesn't bother me. A market cannot go up unless most of the bars are bull bars. And therefore, if I see most of the bars being bull bars, especially big bull bars closing in their highs, I don't give any thought to the high frequency trading firms. I'm going to buy, right? Right. If the market's going to go down, it's not going to have a whole bunch of bull bars. It's going to have a whole bunch of bear bars. So I don't care about the computers or high frequency trading firm. I can just look at the chart and I can see if the market's in a trading range and it's starting to get a whole bunch of bull bars, it's probably going to break out of the top.
Olá, espero que esteja gostando da entrevista. A Trader Brasil foi eleita por 2 vezes no Ranking Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá, ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
Get your small piece of the market.
No.
Your tiny piece of the market is yours. You get it. You don't bother if they are making billions or millions. You get your small piece and you are happy with that.
Yes.
So, Felippe, what question would you like to ask Al Brooks that you have never asked?
Well, this is for the price action community. What do you see as the most common mistake traders make when learning price action, and how can they best overcome it?
The biggest one is, not knowing when they're wrong. Okay? You have to have some way to know when you're wrong. And there are 2 ways that beginners should have. Okay, let's talk the example of a bull trend. One is you have a protective stop. You have the stop below the most recent leg up. So that's a reasonable thing. Another way to know you're wrong is, let's say you're in a bull trend and there are now consecutive big bear bars closing near their lows. You exit. You exit below that second bear bar. So, it could be well above where your stop would be, but, a strong bull trend should not have consecutive big bear bars closing near their lows. And if you see that, the market's probably not in a strong bull trend anymore, and therefore you should exit. So, I think the most important thing for beginners is exiting when they're wrong. And those are the 2 easiest ways to know when you're wrong. And again, trade your absolute smallest size. And, even if you're rich, if you're starting trading, trade this absolute smallest size until you're consistently profitable.
Okay. Before we let you go, where can our listeners find you, your books, and your courses? Where the audience could follow your work on social media?
Well, the easiest thing is brookstradingcourse.com. 3 words. It's actually one word, brookstradingcourse.com. And there you'll have links to everything.
Okay. You heard him. For anyone serious about mastering the art of trading, I can recommend all works highly enough. It is dense, it is challenging, but it's a real deal, the real deal. All this has been an absolute masterclass. The clarity and depth you bring to reading a chart is second to none. The idea of waiting for confirmation, understanding the market is always in. And respecting the chaos of the open are lessons that can save a trader years of frustration. Thank you so much for your generosity and for sharing your wisdom with us today.
Thank you very much, Flavio. It's my pleasure. Felippe, always great to see you. Thank you both.
Thank you. Bye-bye, all.
Bye-bye.
And see you in Orlando in 3 weeks.
Yeah.
Okay. Thank you very much, all.
Foi legal, né, cara?
Pô, gostei. Foi muito bom, né?
Ele é muito simpático, cara.
Fala bastante, né?
Só que a voz
você avisou, né? Mas ele é porque ele gosta do que ele está fazendo, então...
Não, ele adora, o cara adora, e ele dá umas sacadas assim no meio. Assim, as respostas tem que ficar atento, porque ele sai um pouco, às vezes, da linha, mas vem conteúdo bom.